will to drive this market lower. So after point C was formed, you can see that there was very little follow-through to the downside. That's typically one of the first clues that a pattern may fail. If you don't get the momentum, if you don't get a big red candlestick, then that's usually a sign that it's going to fail. The other thing is you can see that if you are going against a trend in this case and you're shorting the market, that you have a quick exit at C. All right, as long as you have an exit identified, really trades there are no trades that you should pass up, because each trade has the possibility of turning into a big winner. And typically when you are trading, you should realize that big winners just happen, but you have to be in the market to take advantage of them. Big losses are the ones you have to avoid. Those are the ones that kill your account. Okay, so losses are going to occur, but big losses are the ones that you have to prevent. So the other thing you want to note is that once point C was violated, you can see the size of this candlestick here through point C. So besides looking at this pattern as an indicator for a counter trend move, also note that when the market does reverse through a previous top, in this case, or even previous bottoms, that there is oftentimes a pretty big move. This could be a combination of stops, or it could be a combination of fresh buying. So keep that in mind, that even if a pattern's wrong. Now, if we look at the New Zealand dollar, because they move the same, the Australian and New Zealand dollar, I'm pretty sure we're going to see a similar pattern develop there. Yeah, same thing as I said. What happens here is no follow through. First clue that the market may not be, this pattern may not be working. And at the same time, you can see, boom, volatility increases. Another thing that you want to note is that all this trading activity here took place before the U.S. economic report, the non-farm payroll report. Okay, so I think I've mentioned that volatility is really what drives these patterns. So when you're approaching a major report, whether it's an earnings report for equities or whether it's a big economic report such as unemployment report or PMI report or maybe a central bank report, then it may not be the best time to trade because activity slows down to nothing, and that could actually skew the pattern also. All right, so let's take a look and see what we have here in the stock indices and see if anything came up for this 3-point extension. All right, in this case, we did get a higher high here, and the market has begun to move sideways and break back. But once again, because of the fact that this was taking place prior to that unemployment report, we have a slowdown in activity. Seems to be heading that way, but we're just not certain at this point whether this market can continue down. But the best thing about it is it identifies a natural exit or stop point, and that's point C. All right. So moving on now, back to our screen, take a look at another pattern that is part of this ABCD pattern, as we talked earlier, and this is the 3-drive pattern. All right, you can see there's a lot more detail. So if you start with the ABC pattern and you master that one, these other patterns become much easier to use. If you start to use these complex patterns without knowing the basics, it gets a little bit more complicated and a little bit more difficult. So what happens here is you have 3 consecutive symmetrical swings here. Okay, so this move here from X to A, B to C, and now it's predicting D to move into a certain area, into these retracement zones. But it's following a symmetrical move. Also, not only is it being connected by these swings or these tops and bottoms, but it also drawing this hyphenated line from X out into the space, also picked off this particular top here for D. So you are our auto chart is picking up the symmetrical movement of the market. All right, actually inside here you have two intertwined ABCD patterns here and then also here. So that's why this 3-drive Fibonacci is important, because again, it contains the two or the main pattern, the ABC, or that lightning bolt pattern, and then what draws it all together is this connection between this point and this point that's drawn out into infinity. All right, and the same principle works, all right, that once this market makes a top, all right, you're going to get a retracement, or you're looking for a retracement into one of these zones. And again, as I mentioned several times, you have the choice to either be a trend or counter trend trader, to either trail your stop, set a target, or re-enter the market in the direction of the trend, or to go against the trend. All right, now what we're going to do is we're going to move on to the live data again, and we're going to see if we have a pattern that came up this morning in the stock indices. Let's go to currencies first, because stock indices will be opening, so maybe a few minutes before we start getting some fresh signals as it starts to digest the market's movement. So we're looking for 3-drive with the FX majors. Well, there's not a lot of completed patterns, but I've been waiting for an emerging pattern so I can show you how AutoChartist makes predictions. Okay, in this case, you can see that we haven't had a completed pattern on this 3-drive since September 13th. So it hasn't been, the conditions haven't been right for this pattern. Okay, now from a predictive standpoint, you can see that it was clearly a very strong pattern here, and that this predictive line here pinpointed an area where the market should have turned. So D should have been a turning point, but the market did not have enough momentum to carry it up to any of these major retracement points. It looks like it failed at about a 382, but it also traded kind of sideways to higher to lower. So it was kind of a skewed pattern after that. But looking at here on this emerging pattern, looks like this pattern hasn't shown up either since September 13th. So again, it's a complex pattern. The markets may not be calling for that type of pattern. So you're looking at an emerging pattern. When you go to emerging pattern, you'll see that this dot here is different than a completed pattern. So with this dot, we are predicting that the market, if it continues on this path, okay, this path on point C that started here, that it could reach this level. All right, as you can see that the market didn't reach this level, but just about the same time frame that we are looking for this level, the market did make a change and turn down. And again, that's the symmetry, because what happens here, the market measures time and price from A to B, and it tries to make the same forecast for C out to this point, which is eventually should have been point D. So time seemed to be right for the turn, but price wasn't right. But again, at this, as you can see, there aren't a lot of fresh patterns here. So we're going to move on and look at another complex pattern, and that is going to be our butterfly pattern. All right, this is a favorite of Yvette, and so we'll spend some time describing what a butterfly pattern is. Now, butterfly pattern is an ABCD pattern, but it's preceded by a significant high or low. All right, in this case, this is a long move down, and this point was a very important low at the time it was formed. Okay, and it represents a convergence of Fibonacci extension ratios. Okay, so if you remember the 3-point extension pattern. Now, point D, which is down here, is essentially where this dot is actually an extension of B to C, and also from X to A. All right, so it's an extension of this move. All right, and it's formed by connecting two of these triangle patterns. All right. Now it's also similar to a Gartley pattern, which I'll show you in a few minutes, but it resembles, when at a bottom it resembles a W, and at a top it's going to resemble an M pattern. Okay, and what it indicates is that this market is probably making a reversal pattern. All right, and by knowing where this can occur, okay, by looking at it in an emerging pattern, as an emerging pattern, you can get a pretty good grasp of risk reward. All right, if you're pretty confident that the program's selecting good tops and bottoms, then you can enter this market as it starts to turn fairly quickly, and you can get a good grasp of risk reward, because once you know where it can turn and you have confidence that it's going to take place there, you can enter the market and know that your exit's right underneath this. Because what's good about these Fibonacci patterns is your exit is simply at a point where the pattern fails, where it no longer exists as a ABCD or an extension or butterfly pattern or Gartley pattern. So that's why it follows a rule that I like to follow, and that is that the quickest out is the best out. That if you have to linger around in a trade a long time, it's probably not going to work out for you. So the faster you can get out of a trade that's wrong, the better off you are, because let's face it, your head's clear, you just think a lot better, okay? And you can take advantage of opportunities taking place in other places. So one beauty about using this butterfly pattern or any of these Fibonacci patterns is you have easily identified exits. And that's the key to becoming a successful trader and maximizing your profits, is because you're actually, in the long run, going to maximize your profits by minimizing your losses, because you're out fast. So that's really good. The other thing is, if this pattern fails, in other words, if this market reverses back down through here, tends to indicate that there's going to be a strong continuation pattern to the downside. So that's important to note, is that if you are wrong on one side, don't give up on the pattern. You can turn around and go the other way, and that's usually a key element of a Fibonacci pattern. Can't say that about a lot of patterns. For example, if you use moving averages, you can't count on a market turning around and reversing the other way. Sometimes it'll linger around an area. Okay, so let's take a look at our Fibonacci, or our FX butterfly pattern, and see if anything's come up, if conditions have been right here. This too doesn't look like conditions have been right. Because of the sudden turns in these currencies and because of the trending markets in these currencies, I think the ABC, D, and the extension and the 3-point retracement are more popular patterns. It seems to me that the more complex we get, the conditions just haven't been right. And if you've been watching the markets, you can see that for the last 2 weeks or so, the trends have been kind of sideways anyway, especially in like the equity markets. All right, so we really have nothing fresh to show, but you can see that we're going to still identify movement. And again, here's one where point D was formed, and we were looking for a breakdown. But as I said before, look at how fast you can get out, and look what happens when it reverses. Okay, so even though this pattern was a failure, you could still turn it into a positive, because it showed this strong continuation once this point D was broken. So that's one positive, is that you can always expect a continuation move when these patterns are reversed. And seldom, if you trade a volatile enough market and a market with enough volume and volatility, seldom are you going to get a market that will go one way, reverse, and then go back. Typically, once it changes direction and it continues on its way, it'll continue to move that way, because that's how trending markets move. Okay, so we're going to move on now to our final pattern, and then we'll open it up to some questions. And that final pattern is a little bit, or the most complex, and that's called the Gartley Fibonacci pattern. Now, it's named after a man named Gartley, who was I wrote books back in the 20s and 30s on the markets. It's one of those books that